Good afternoon and welcome everyone to Market Movers, another great webcast from Schwab Coaching. My name is Ben Watson and there is the bell, and that tells me that it is Friday afternoon and we're going to get started here with this discussion. I'm joined out in the chat by my good friend Brent Moores, who's going to be there to help answer your questions. Brent's 20 plus year veteran of the financial markets and a great educator and a good friend, and I'm glad to have him here. It looks like we've got all the usual suspects in the discussion today. So thanks for being here. Whether you're joining us in the live version, whether you're joining us in the recorded version, you can chat in, you can leave comments. We encourage you to participate in the discussion. I know this week went very fast. We're going to talk a little bit about what happened this week. We're going to take a look over the horizon at next week. We're going to throw some ideas in there as well, but just a couple of quick housekeeping items, and then we'll talk about this webcast and what our intent is as we kind of move forward with it. Remember, everything we talk about is simply for illustrative and educational purposes only, not a recommendation of any particular security or strategy or account type or anything else. Remember that options, should we talk about them, carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Remember that spread trading must be done in a margin account. Multiple leg option strategies will involve multiple transaction costs. We'll talk about those along the way. Remember that short options, if they're American style, can be assigned at any time up to expiration, prior or up to and including expiration, regardless of where they are, in the money, at the money, out of the money. It doesn't matter. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It's a great learning environment. It's a great sandbox to play in and evaluate and learn. It doesn't do certain things that a live trading account may do. It doesn't facilitate the early assignment of short options, and it doesn't allow you to use studies typically in scans and searches. So if those come up, we'll point those out along the way as well. Lots of different ways to look at the market. We're going to touch on a few of those today, technical analysis being one of them, probability analysis, fundamental analysis to a certain extent. Remember, those are all theoretical in nature. None of those are guarantees about what's going to happen in the future, and therefore Schwab doesn't recommend the use of technical analysis or really any other form of individual analysis as a sole means of investment research. Past performance, no guarantee of future results. Investing involves risk, including the loss of principal. We'll talk about stop orders if we bring those up in this discussion. Of course, we may also take a look at some other things as well in this discussion. We're going to be looking at indexes as a means to evaluate the market. We're going to be looking at futures markets potentially as a way to evaluate what's going on in a particular market. We're not advocating or specifying or giving any information about trading specific futures, just looking at those as a measurement of market movement. So as we get into those things, I will point out specific characteristics and cautions as well. So let's jump into kind of our agenda here. We want to take a look at what's going on over the course of the last week, what moved the markets this week, how might portfolios have been impacted. We'll take a look at our kind of sample portfolio that we've got in this paper money account as well. We'll take a look at the protective put, or one of the protective put ideas that we looked at last week, and see if it needs some evaluation. But my goal in this webcast every Friday, when I'm able to teach it, and I think Brent's going to be teaching it for me next Friday because I will be in Seattle. Some of you are going to be there with me at the live technical analysis and option strategies workshop. But we're going to talk about, ideally every week, just kind of a sense of what's gone on. I want this to be a way to kind of wrap up the week from a trading perspective, to get a sense of what's happened and what moved the market, but also kind of a way for all of you to come together and participate in the comments and the chats and the discussion. Have this be a community kind of gathering, if you will, at the end of the week as we look over the horizon for the next week. So I'm going to do this. I'm going to switch over to our Thinkorswim desktop software platform. We're going to take a look at what's gone on over the course of the last week. We'll use a couple of other sources as well. Remember, any third-party sources of information that we look at simply for illustrative and educational purposes only, they may or may not reflect the viewpoint or opinions of the Charles Schwab Corporation. So let's jump into the SPX here as we see the course of this last week. Last Friday, when we were here on the 17th, we were kind of looking at this from the standpoint of saying, hey, the market is banging its head right up against that 50-period simple moving average. And if we zoom in a little bit more, we can kind of see the move that the market made, the SPX, the broader cross-section of the market, move up above that 50-period moving average. It did it with some momentum the next day. Then it kind of ran into this previous high resistance right around that 6,100 mark. And then it rallied up through that level with a little bit of a gap down and rally candle that kind of took us to the high yesterday. And now we see a little bit of a backing off today, coming back down to that 6,100 level as now potentially a level of support. And, you know, support is one of those things that we've talked about quite a bit in terms of technical analysis. When we see support happen on an index, that generally means that it's happening over a broad cross-section, that we're seeing some support being an area where maybe a number of stocks driving the index have pulled back to levels of support and are seeing a little bit of buying pressure stepping in. Support is an area where buyers typically tend to enter or buy. Same thing with a breakout above a resistance level. Not always, but generally, when we see price pull back to an area where it's changed direction before, we look for a direction change, right? So when price breaks above a resistance level and then pulls back, it typically, but not always, uses that level as a level of support. Seems to be doing that here today because we didn't come back down through yesterday's candle. So we could maybe argue that this is a little bit of neutral movement today, maybe a little bit of sideways. I don't know necessarily how bearish this today was. I mean, we were down 0.29% on the SPX, but from a bearish perspective, from a trend change perspective, maybe giving us an indication perhaps of a little bit of a pause more than anything else ahead of. So if we think about it from a weekly standpoint, this was a relatively data light week, this last week that we've been in. Going into next week, we've got a fair number of data points that are market moving. And oftentimes it goes that way, right? We'll have this pause where we'll have kind of a data light week where the market kind of digests things and moves quickly. Now, that being said, I mean, it wasn't an information light week by any means. I mean, we had the presidential inauguration at the beginning of the week, and that informed, or at least created some expectations for the market over the course of this last week, whichever side you might be on, right? And so here we are. We're left with this little bit of a kind of spinning top candle up here at the top of this resistance level above the support. We're seeing the RSI kind of ticking back, which is an indication perhaps of that move back to the downside as far as momentum, kind of backing off a little bit. So a number of different ways that we can look at this. Not terribly bearish, but maybe neutral in its approach. Let's take a look at the NASDAQ as well and kind of get a sense of what the NASDAQ, the technology-heavy NASDAQ. And Greg, hang on a second, and I'll grab that link for you here, and we'll talk about that label for just a second. But we can see the overall trend, the breakout of this descending triangle over the course of this last week, kind of on that 17th. We saw it Friday, and then boom, 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 and then it goes sideways. We see the NASDAQ make a move to the upside and then go sideways. A little bit maybe more neutrality here in the NASDAQ than in the SPX. The SPX including some of those names in that list, some of the banks that we saw last week, some of the airlines that we saw on the list, making a move to the upside. So some strength still there that maybe is not necessarily present in the NASDAQ at this point. But it wasn't a big earnings week this week, with the exception maybe of Netflix, for instance, and some of the airlines. The Russell 2000 kind of spent the week kind of above that resistance level but below the 50-period moving average. So it's kind of getting squeezed down into this very narrow range. And as a matter of fact, I might even draw kind of a little, kind of, in this case, a pretty acute. There's a joke right there for you, just well written for you. But it's a pretty acute, narrow triangle at this point on the Russell 2000. Pat Mullally and I used to call these Cobra patterns when we would do a show in the mornings called the Morning Huddle. And the Cobra pattern is simply a symmetrical triangle, short-term symmetrical triangle, typically one candle wide, at the top of or at the bottom of a directional move. And so we see a directional move to the upside and a little bit of a squeeze here. The Russell in this case kind of winding itself up, or coiling itself up, much like a snake would, or much like a cobra would, and kind of giving us the head of the snake here with the possibility of a break to one side or the other side. Oftentimes, cobras are a little wider, right? They tend to be a little bit more obtuse as opposed to being this acute or this sharp. But we see the same kind of characteristics here, holding between that 50-period moving average and the support level below. Stuck between the moon and New York City, if you will, right? If you're a yacht rock fan, you know what I'm talking about. So as we look for that possibility of a breakout, right, one of the things that has been keeping this market kind of in check, if you will, in terms of this upward movement, and especially here in the Russell 2000, in the kind of small cap space, has been interest rates. And interest rates have been one of those things that perhaps have influenced the market maybe more than we know. I'm going to pop over here really quickly before we get into anything else to my single grid kind of sandbox, if you will. And we'll just take a look at /10Y. Now, this isn't a futures contract specifically that we're looking at. This is the futures market that reflects the 10-year yield. And we can see what's gone on in the yield over the course of the last week. We saw the big drop, a little bit of a pullback, but then we saw yields rising once again. Today, they came back in a little bit, and that may be what is kind of helping keep, especially the Russell 2000, kind of constrained somewhat in the fact that the Russell 2000 typically tends to be very yield sensitive, very interest rate sensitive. And so we're kind of seeing that perspective right here, with rates still back on the rise over the course of the last week, maybe moderating that upward potential in the small caps. Now, speaking of rates, and this is something that I think at this point we need to talk about, is the fact that we've got a big data point over the horizon in terms of rates. And that is the first opportunity in 2025 for the Federal Reserve to cut rates or adjust rates. So we've got a Fed meeting starting next week. In fact, that's part of our weekly calendar. And that meeting comes and the decision comes on Wednesday. Typically will come out around 2 p.m. Eastern time, around noon Mountain time, where I'm located, where Brent's located. So that's going to be a market mover, I think, next week, regardless of what happens. Not necessarily significantly, not necessarily over a longer period of time, because there's some lowered expectations for what's going to happen. But it's likely to move the market, or at least create a little bit of volatility. And if I draw a line right here, I think, as Kevin said, a potential kind of short to intermediate term head and shoulders pattern forming here on the rate picture. Now, again, this futures contract is reflective of rates. So this is going to be the inverse of what bond prices, 10-year bond prices would be, right? When bond prices go down, rates go up. When bond prices go up, rates go down. It's that inverse kind of teeter-totter or seesaw relationship. So what a move lower would mean would be bond prices going up, which would mean that more buyers would be coming in and buying bonds, pushing those prices up, pushing yields down, right? So you got to think about where some of those bond buyers have been traditionally. Those bond buyers have traditionally been sovereign funds, uh, China, for instance, India, other developing and emerging and also developed markets have been buying treasury bonds over the years. Now, maybe they've stopped doing that's one of the reasons why potentially rates have been going higher. And so things like tariff talks and trade discussions and things like that have an influence on rates beyond just the costs of goods and imports and those types of things. So if we take a look at what this looks like, right? So being a head and shoulders, the potential here is for a break below that neckline, right? And the idea would be that we would potentially see or possibly see a symmetrical movement. So if this broke below that support, that may put rates back down here in about that 4.3 range or so. That would take some movement in bonds, right? In bond prices. We would need to see some significant upward movement in bond prices to see these yields drop. Just the Federal Reserve cutting rates isn't going to push the string far enough to push the 10 years to the downside. It just doesn't work that way. It's not a direct cause and effect, because remember that the Fed only impacts the front end of the curve primarily in terms of what their influence is, that overnight front end of the curve, not out here in the middle of the curve or the longer end of the curve. Out to the 30-year end of the curve, certainly not. That becomes a function of time and distance, right? Time and the distance that those bond prices can move. But let's take a look really quickly while we're talking about rates, because I think this is a good time to pop over to another tool that we might use. And that is, and again, this is a third-party tool, but this is the CME FedWatch tool. So this is the CME group. They provide this information, and this is a third-party provider. So this is not generated by, nor endorsed by, nor in any way controlled by Charles Schwab. But this is the CME, the Chicago Mercantile Exchange is the abbreviation, but the CME FedWatch tool. And this is looking at the probabilities based on Fed funds futures of movement by the Federal Reserve. So they break it out by meeting date, and they say, all right, what's the probability based on futures moves for the Fed to cut rates or do something, adjust rates at their next meeting, right? So this is the meeting that comes up on the 29th. The current target rate is 425 to 450. Put a decimal point there after the 4, and you get the number, that rate number. And if you look at where this is, right, you see the target rate. Target rate is 425 to 450, 99.5% probability based on the CME, based on Fed funds futures, that the Fed is going to leave rates absolutely alone. Slight 0.05% probability in this particular case that the Fed cuts by a quarter point. All right, that would move the target rate down to 400 to 425 bips. And so this kind of gives you that expectation. We have to go out. If we start looking out forward, here's the March meeting, which would be the next meeting. So about a 71% probability right now of leaving rates alone, about a 28% probability of cutting rates. We go out to the May meeting and we see that shifts again a little bit, but this is a function of time and probability, right? That there's a greater probability simply because there's more time for things to change. If we were to go deeper into the fall, let's say, for instance, to the 17th of September, now you see there's kind of a probability curve that's going on here with, some traders taking a speculation that there might be a bigger rate cut, right? Going into half a point. 18% chance of leaving it alone, 38% chance of a 25 basis point cut, 30% chance of a half a point, 11% chance of 3/4 point, 2% way on the outside in that tail of a full percentage point rate cut in that meeting. And again, that's just a function of time and probability. So this is an effective tool to help us just kind of visualize what those expectations are. All right. And kind of the cool thing that we can do with this is we can see the comparison between the last few weeks. If we look over the course of the last week, so here's that 425 to 450 basis points right at the target rate, leaving that the same. And we can see that over the course of the last month, so we go out to this month, that's that kind of light blue on the right-hand side. From a month ago, day before Christmas, there was an expectation, lower expectation, about 91%, that the Fed would leave rates alone. We can see that over the course of the last week and the last day, and now today, that probability of leaving it alone has gone up. So it's just kind of staying right there, right? Hasn't really changed very much. And this is something you can do. You can do that compare tool to see how things change based on the news that is happening. All right. While we're out here in the not in the Thinkorswim platform, I want to pop right over here to the Schwab.com website. And we did this last week, but I went to the Schwab.com website. We went to the research tools section, and I went to research tools, and I went to the calendar. So I want to look at a couple of things. I want to look at the calendar events that happened this current week. All right. So we're going to pop into this current week. I'm just going to use the calendar. I'm going to look at economic events, and we'll see what happened over the course of this week. All right. So we have leading indicators, which came in right in line with expectations. All right. Maybe a little bit softer than expectations. Again, leading to the presumption that rates would be left exactly the same. And maybe not hiked, but left the same. Maybe not cut, but left the same. Right. Thursday, we had things like continuing jobless claims, which came in kind of right about the same number that we saw in the previous report. We saw initial claims that were just a little bit higher, giving us an indication maybe of some weakness in the labor market, but not a huge weakness in the labor market. Oil reserves were drawn down less than was expected and less than happened in the previous week. And we saw natural gas reserves pulled down less than they were the previous week, which led to some softness in energy, right? Which led to some softness there in that energy approach. All right. So let's take a look at what happened on Friday. Today, existing home sales came in just a little bit hotter, just barely a little bit hotter than was expected. And that might suggest, again, that if rates were backing off just a little bit, that adjusted the mortgage rates. We saw mortgage rates go down a little bit. We also saw things like PMI, manufacturing PMI, moving a little bit stronger into expansion, just barely ticking over into expansion. So PMI, the Purchasing Managers Index, indicates expansion if it's above 50, indicates contraction of the economy if it's below 50. So we're at 50.1, so it's barely ticking into expansion. Global Services PMI, so not the manufacturing sector, backed off. Still expansion, still at 52, above 50, but it's at 52.8, which is down from the prior month's numbers. So services backing off, and services have been one of the growth areas in terms of the labor market. So something to pay attention to there. And then consumer sentiment down about 0.3% or so here over the previous number, and then below considerably by about 2% below the expectation in the market. And again, third-party expectations, third-party providers of that information. So be aware of that. But remember, this is one of those things that drives retail sales, consumer sentiment numbers. And what did we have in this last week's earnings? We had one of the fairly reasonable indicators and one of the most resilient indicators of consumer sentiment and retail strength, which has been the airlines and how profitable the airlines have been. So we'll start to look at that here in just a minute. But the other thing that we can do is we can go over the horizon. We can look at next week. So next week starts the 27th. So we're going to click on the next week in January. We're going to take a look. We've got new home sales that'll corroborate or invalidate those existing home sales numbers. Forecast is for 685,000 against 664. So forecasting a little bit of growth. Looking for consumer confidence and durable goods and orders that could be a little bit stronger, expected to be stronger than the prior numbers. Case-Shiller numbers. We've got crude oil inventories. But here's that big one, the FOMC rate decision. That could be a big one. We've got GDP coming out next week as well. And then we've got PCE, which is the Fed's kind of preferred inflation gauge. So this is going to be the first kind of realistic PCE inflation metric that's going to have some influence by the new current administration, right? So we'll see what happens there and see if there is a decrease in those numbers, right? So, and as we start to see those moves, these are going to be some of the things that are going to perhaps influence the market going into next week. Earnings over the horizon next week. We start to look at these earnings numbers and these earnings expectations. We've got companies like AT&T. We've got some of the other large cap or mega cap blue chip stocks. We've got in some of these announcements we start to look through here. Let's bring up some of these other ones. Oh, because I'm just on that one day. Let's go to the 28th. So we've got Boeing coming with earnings next week. We've got Lockheed Martin. We've got General Motors. We've got Cisco. We've got Synchrony Financial in the bank space, which has been kind of in that subprime bank space as well. We've got Danaher. We've got General Dynamics. We've got MSCI from the standpoint of kind of that the Bitcoin and crypto and AI space. We've got coming up on Thursday of next week, again, some of the consumer sentiment issues with MasterCard and Visa. We've got some of the ag industrials, United Parcel Service, which is a good read on business activity. And then going into Friday of next week, we've got some of the energy companies starting to report, ExxonMobil, Chevron. And these reports are going to, I think, one of the things that's going to be important to pay attention to. In Exxon and Chevron reports, Hess reports, Phillips 66. So you got some of the refiners as well. Is going to be their forward guidance and what their expectations are in terms of drilling and in terms of exploration and production. So those are going to be some of the things to pay attention to going in next week in those earnings. I like what Isaiah says, which is Wednesday is kind of the Super Bowl of earnings, if you will. We've got a lot of those names coming out. We've got Brinker, which is an important one as well. We've got Microsoft, which is coming out next week, and others. So it's going to be an important week when it comes to earnings. So something to pay attention to there in that space. So a good calendar to take a look at really quickly, get a sense of what's going on. So let's pop back over here to the Thinkorswim platform and let's kind of jump back into some of these other ideas. So I want to talk really quickly. We've looked at we've looked at indexes. We've looked at the rates, interest rates. Let's also take a look at a couple of other things here. Let's take a look at VIX and see what volatility generally has been doing. So I'm going to pop over here to my VIX grid. And we can see that volatility has been falling, but the volatility of volatility, the VVIX, the volatility of volatility, meaning how quickly and how significantly the moves have been in volatility itself, and likewise then how expensive volatility has been going up. So even though VIX has been going down, the volatility of volatility has been increasing. If we just look at the VIX itself, we can kind of see this move back down below its average. We see the market moving higher with the VIX moving lower. Generally, that is going to be the relationship when SPX moves up, VIX moves down. And we saw a little bit of a down move today, but the VIX kind of holding its own. didn't really move. And I think that right there, that relationship of the SPX to the VIX, right? SPX moving down, the VIX moving down, or staying right about the same suggests that the market's not terribly worried about this little bit of a pause in the SPX, if you will. All right. I want to look at two other things. Let's pop back over here to our single grid, and let's take a look at /CL. This is the crude oil futures contract. And the crude oil futures contract, look at this on an ongoing basis. We can kind of see what's gone on over the course of this last week. Post-inauguration, we saw the move to the downside, 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 maybe back down into a support here today, right around that 74 mark. And we can kind of see where that support level exists or has existed. No guarantees that that's where it's going to stay. We might see a little bit of a bounce here. We might see a push back down. But what's interesting to me is if we take that symmetrical move that we saw, that triangle that we saw winding up going into December, right? And we take that move and we just duplicate it and we put it here where it broke out of the triangle. Guess about where that went to. It went right about to that $80, $81 range. So this was kind of a symmetrical move to the upside based on this triangle that happened, right? So here's the thought. We see symmetrical move here. It moves once it breaks out to a similar distance. So we might see this come back all the way back down if this transits that symmetrical distance all the way back into that $69, $70 range before it finds some major support. And this is just simply looking at it not from a political standpoint, not from a supply and demand standpoint, but simply from a technical analysis approach, right? And that's what's going on with crude. And as many of you know, if you were in Florida, that there was a lot of weather activity. It's been a cold week. So if we take a look further here, /NG and natural gas prices came off a little bit, but they didn't really make a big, strong move to the upside that we might have expected given the weather over the course of the last week. But still on the rise, still in a pretty good long-term uptrend here. All right. Now that we've taken a look here at kind of the broad view of the market in a variety of different places, let's take a look at some individual names as we kind of roll into what's been going on over the course of the last week. I wanted to take a look at some of those major names that saw earnings over the course of this last week and just kind of get a sense of what's going on and what moves they did make post those earnings announcements. The one that kind of really stuck out was this one, Netflix, in terms of subscriber growth and this move to the upside. We talked a little bit about this. I looked at this in terms of the flag movement that we saw. So the earnings came out on the 21st, which was Tuesday, as the market opened. And we saw this move to the upside, the gap up and a little bit of a sell-off, but it came right to the kind of this resistance level that was at the top of that kind of flagpole or bull flag type of move, right up into this 982 mark. So even if we'd not known where this was going to go or what those numbers were going to be, we might have been looking for a little bit of resistance up here around this 981 mark or so. So Netflix is a streamer, seeing good subscriber growth, seeing a rate increase, and resiliency in terms of their margins and guidance looking forward pretty good. We saw a big pop to the upside here, and let's see how that impacted maybe some of the other streamers. If we take a look, for instance, at Disney. Disney was up somewhat in sympathy with that move. We see Disney has earnings over the horizon a little bit further. If we take a look at CMC SA, Comcast, we saw Comcast ahead of their earnings next week as well, on the rise a little bit, but they've been down. They've been kind of battered down somewhat from a streaming standpoint, from a content standpoint, from a subscriber growth standpoint, from a margin standpoint. So, starting to see a little bit of a relief there, right? So now, as we start to see that, again, I mentioned one of the kind of retail influencing areas or retail reads might well have been some of the airlines, right? So big airlines that we had this last week, UAL, United Airlines, with their earnings announcement. And we see their earnings announcement here on the 21st. Conference call a little bit later, but we saw 326 actual against 3.009 expected, and a big run up to the upside, a little bit of profit taking, but holding kind of a support level here off of the top of this kind of double bottom reversal pattern. So kind of draw a big, wide, fat magic marker support level right here, and the stock stays at or above that support level. So, this is one of those things that, as an indication of some strength and guidance going forward, the airlines have been pretty remarkably resilient. But the other big airline announcement that we had this week, AAL, American Airlines, kind of went the other direction. And, we've been talking about this on a variety of places. It's been in some of our webcasts. It's been a topic of discussion in the Schwab Network over the course of this last week. Remember, the Schwab Network, separate but affiliated, is brought to us by our media affiliate, Charles Schwab Media Productions, which is a separate but affiliated company, not a broker dealer or financial advisor. And we see that United Airlines made that move back down to the downside here, and a little bit of a sell-off, but still holding that support level, kind of this island reversal almost, if you will, if we see a continuation, but holding a couple of levels of support here on American Airlines. And we see that their earnings announcement, while good, they beat the numbers. Again, one of the things was forward guidance for American. So one of the other names that was kind of in concern this week, and I think this is one that I want to kind of wrap into our discussion of specific trades, was Apple. And this was a stock. We've got an earnings announcement coming up on the 30th, so just a little bit over the horizon, but we're now kind of sandwiched in between a couple of things. We're sandwiched in between CES, Consumer Electronics Show, where Apple has kind of backed off in terms of their presence. But we've heard them, announce new products. We've seen some of their new releases. We've seen some of their numbers on iPhone sales. And they've been sandwiched in between that, along with the whole TikTok issue and banning TikTok on the App Store. Still, to this day, to this point, can't download TikTok again. So there's news out there that people are selling pre-owned iPhones with TikTok already installed for exorbitant amounts of money on auction sites. But we've seen this downward move in Apple. And part of this, I think, has to do with maybe some of the concern about Apple participating in AI to a great degree, but they're back down to a support level. And back down to this 219 range, we see a little bit of a bounce to the downside. So earnings may be the catalyst here that drives this back. But this is a typical January pattern for Apple. We see a January swoon typically for this particular stock. So what I'm going to do is I'm going to come across here and we're going to draw this level of support right here. So for traders who might be long a position like this, right? This is something that from a technical analysis standpoint, traders can do fairly easily, especially here on the charts and the Thinkorswim platform, is either put things like moving averages on here or draw lines on the chart, trend lines on the chart that can give you some ideas about where trends have been broken or maybe changed, right? So longer term trend maybe has been changed a bit, maybe now in an intermediate to long-term sideways trend as opposed to a longer-term uptrend. But what we did over the course of this last week, if we go back to the monitor tab here and we look at our market movers, we've got a long position in this paper money account of 100 shares of Apple. And we've got an option, a protective put option that expires 14 days from now on the 7th of February. All right. And the protective put here in this particular case gives the buyer of that put the right to sell the stock at the strike price. The strike price here is 245, right? So even though the stock's currently trading at 222 on the market, this put option, which was purchased for $22.70, now currently trading at $22.70, gives the buyer that option the right to sell the stock at 245. So let's kind of do the numbers here. I'm going to pop over here to the left-hand side. We'll bring up our gadget really quickly, and we'll bring up our calculator. So let's think about where the stock is now. The stock is currently at 222.70. So let's go 245. That's where our strike price is, 245 minus 222.70, and that's about $22.30. So if an option buyer were to choose to exercise their right to sell the stock at that 245, they would realize theoretically $22.30 of intrinsic value in that protected put option, right? Between selling the stock at 245 versus where it's currently trading at 222.70. But if they were to choose to sell the option right now, selling the option for $22.70 might yield, what is that, 40 cents more for selling the option. So that's kind of the decision here. So if an option buyer, somebody that held that long put option, that protective put option, wanted to use this as a means to exit the position, right-click, click on exercise, and create the order to sell the 100 shares of Apple at that strike price of 245. So it's like creating a precise exit point, but it's going to cost money to use that precise exit point, to have that precise exit point there. If you want to learn more about this, about protective puts, one of the ways to do that is to come over here to our, let's go back to our, there it is right there. We're going to go back here to our Trader Talks webcast page. By the way, click on subscribe if you haven't done so already, and check out protective puts here. And we'll just type in protective puts, and you'll see a bunch of webcasts in here. I've taught them. Barb's taught them in the Getting Started with Options. I know Brent's taught them right here. James Boyd has taught protective puts. So here's one that you might be interested in. The difference between protective puts and stops. You know, one's a hammer and one's a scalpel. So something to think about in terms of utilizing those tools in managing your portfolio or managing trades. So we kind of have that sense of how we can use that. So looking forward, we've got just a couple of minutes here, and I wanted to get into this discussion really quick, setting ourselves up for what's happening next week, MSFT, and looking at the strength of this market and the possibility that over the horizon, maybe we see a little bit of neutral movement up until Wednesday. We've got Microsoft coming, and Microsoft's one of the big players in AI. Their earnings is on the 29th, so after market close. So this is going to be after the news is out. So we're going to look at the possibility of putting on a buy stop order here. If price moves above a certain level, then enter the trade. So in fact, I'm going to use this resistance level, kind of right here at about that 447 mark, as kind of the line in the sand. And I'm just going to say, look, above that, I want to get into the trade and take advantage of potential long directional price movement. Below that, I want to stay out because I want to have evidence that price is moving higher. So I'm going to right click. I'm going to come down here to buy, and I'm going to edit this buy order, and I'm going to say, hey, buy stop. I'm going to use a buy stop, which says stop. Don't do anything until price breaks that 447 threshold. And we'll make that good till canceled because we know that that may take a while for this to happen. So above that level. Now, once we're in, now I could put stops in right now, or I could put protective put in right now. But I want to see what's going on first before I get into and manage those trades. So we'll do that next week, and we'll talk about it. But this is an entry into a long position based on the idea that maybe we see movement in AI. Maybe we see movement overall in the market. If the Fed meeting goes as suspected, and we see that move to the upside here. So there is that. We're going to go ahead and put that out, confirm and send. We're going to put that in our market movers group. We're going to click on send, and we're going to fire that order off, and it's going to wait and see. So as we wrap this up, guys, once again, let me come back over here. We talked about what's gone on this week. We're talking about what's likely to happen next week. We've looked at a couple of things that have moved the markets, that are likely to move the markets next week, and looking at some potential trade examples as illustrations. Guys, thanks for joining me for this week. And as always, keep your arms and hands inside the ride at all times. Hang on and have fun. We'll see you next week. Bye-bye.